This mini lecture will look at some basic accounting principles. Let's start off by talking about what is accounting. Accounting is the process of summarizing, organizing, analyzing, and reporting information about financial transactions that affect an organization or a business. And this information provides users, many times managers, with relevant and timely information that can be used to make better decisions. So besides managers, who else uses this information? Well, there are both internal and external persons that utilize accounting information. Internally, both business owners, managers, and employees use accounting information to help make decisions. Externally, banks use this information to determine if a loan should be granted. Investors, both current and potential, use this information to determine whether they should continue to invest or potentially invest. Creditors, suppliers, the media, government agencies, tax authorities, and unions are all external entities that utilize accounting information. There are also accountants. These are the people that actually take part in the act of putting together this information. So public accountants are persons that provide services such as tax preparation, external auditing, and management consulting to their clients on a paid basis. Management accountants usually work within a business or an organization and provide analysis, prepare reports and financial statements, and assist managers within a company to help make decisions. And then government accountants perform accounting functions for local, state, or federal government agencies. There are also some different types of accounting. In this lecture, we're going to be looking mostly at financial accounting, but there's also cost accounting and management accounting. Financial accounting looks at preparing um, and profit and loss or income statements and balance sheets, as well as cash flow statements. Cost accounting really analyzes the costs that are occurring within an organization to control for and to maximize efficiency. And management accounting helps with assisting management to plan, make decisions, and to evaluate their decisions. Let's go a little deeper into financial accounting. Financial accounting is a branch of accounting that prepares financial statements that are utilized to analyze the financial condition of an organization over a specific period of time. When creating these financial statements, generally accepted accounting principles or GAAP are used to prepare the financial statements. The Financial Accounting Standards Board, or FASB, established these GAAP principles and aims to ensure that all financial statements are relevant, reliable, consistent, and comparable. And these standards really came about after some unethical business practices occurred, and it was realized that the industry needed to have a little bit some more standards to abide by. One of the pieces that financial accounting looks at is the balance sheet. So the balance sheet reports the financial position of a firm by identifying and reporting the value of a firm's assets, liabilities, and owner's equity. Assets are resources that are owned by firms. Liabilities are claims that outsiders have against a firm's assets. And owner's equity are claims that a firm's owners have against their company's assets. And so in a balance sheet, your assets must always be equal to your liabilities and your owner's equity. So let's take a look at an example. This is a sample cash flow statement, or excuse me, a sample balance sheet. Excuse me. So over here on the left side, you'll see that we have assets. We have current assets like cash, accounts receivable, inventory. We have some investments, property, plant, and equipment, and then some intangible assets like our trade name and goodwill and so forth. So the total assets for this example company are $770,000. You'll notice over here that the liabilities for this company takes a look at things like accounts payable, wages payable, interest payable, which are these are all current liabilities that you can see here, as well as some long-term liabilities such as notes payable and bonds payable. And then that's 481,000. And then the stockholders' equity looks at common stock, retained earnings, and a few other items here, which comes to 289,000. If we add our liabilities and our stockholders' equity, it's 770,000, which is equal to the total in the assets, thus balancing out in the name balance sheet. We can also look at an income statement. This is personally one that I use quite a bit. So the income statement reports revenues, expenses, and net income that resulted from an organization's operations over a specific accounting period, usually a quarter, which is 3 months, or a year. So revenue is an income that a business has from its normal activities, which is usually the sales of its goods or services. Expenses are resources that are used up doing business, or an outflow of money to another person or group to pay for an item or a service, or for a category of costs. And so thus, the net income of a business or an organization is equal to its revenues minus its expenses. So let's look at an example. Here we have another sample income statement. Here are the revenues. Most of the revenues come from sales, but there's some interest, and then they sold some assets and made some money on them. So total revenues here are 108,000. The expenses include the cost of goods sold, which really is what did it cost for us to make that product. The commission and some commission they paid out, office supplies, equipment, advertising, interest, and then it looks like there was some legal for a total of 90,000. So if we take our revenues of 108 minus our expenses of 90, we get a net income of $18,000 for this 5-month period that they're talking about here. Another statement that's used is a statement of cash flows, and this identifies the amount of cash that flowed into and out of a firm through the operating, financing, investing, and activities. The statement of cash flows is very important because it ensures that companies and organizations know how much cash they have coming in and out, and make sure that they have enough cash on hand to pay their bills. And so here you can see they look up here in January, they had an initial investment of $10,000. They had some credit sales for a total cash inflows of $12,500. Their total cash expenditures or outflows were $9,750 for a net cash flow or ending balance of $2,750. So we go to the next month, and you can see that they had a net cash flow of $1,000, bringing their total closing balance to $3,750. Right, and so on and so on. So by March, this company has cash flow or a closing cash balance of $4,750. But in April, the company actually had a negative cash flow, meaning that the amount of money they cash flow out was less than the amount that came in. And so their remaining closing balance went down by $1,500 to $3,250. And so this is really important for businesses because it's important to make sure that they can cover all of their costs or all of their, what you might call their bills for that month or quarter. And so that really that's the statement of cash flows can really help us with that. And it can help us to see where the money's coming in and coming out. And this is especially important in businesses that experience seasonality. So businesses that have a season that's busier than others. So for example, if it was a retail business, the October, November, December might be busier months because of people purchasing gifts for gift giving. And then January, February, March might be much slower months, which is very common actually in retail. All right, so how do we interpret these financial reports? Sometimes people utilize auditors to take a look and make sure their reports are what they should be. Sometimes there's notes on financial statements that can help with the interpretation. But one of the biggest things we want to do is look for trends. And we do this through something called a horizontal analysis, where we compare these reports from various quarters or years to see if there's any changes and to identify any trends. And that can help us to make better decisions, as we talked about. So what we just talked about was financial accounting, but there's also managerial accounting, which we talked about earlier. So this is kind of a side-by-side comparison. So the purpose of financial accounting is really to provide information to external stakeholders. That's the primary purpose. And managerial accounting is primarily used to provide internal information. Financial accounting focuses on financial information, whereas managerial focuses on financial and non-financial information. Financial accounting prepares the standard set of financial reports, which we talked about. However, managerial accounting might prepare more customized reports to help to answer a certain question or to solve a specific problem. Financial reports are usually created on a predetermined schedule, where managerial accounting creates these reports as needed. And lastly, financial accounting summarizes past performance and its impact on the firm's present condition, whereas managerial accounting provides reports dealing with the past and helps to make projections about what the future might look like. So that's just a quick side-by-side to help you. Next, let's take a look at some managerial costs. These are some terms that you might hear out in the business world. So some cost concepts include out-of-pocket costs, and this is just money that we need to pay out for our resources that are needed. An implicit cost is a cost that's been incurred, but it doesn't necessarily show up as an expense. So for example, let's say that you had some cash and you could either invest it or you could buy a new piece of equipment. Well, the implicit cost would either be the loss of interest income or the depreciation on that machinery. And these don't always show up and are what I would like to say kind of fuzzy and harder to account for. Fixed costs are costs that remain the same no matter how much you produce. So the things like this include your rent, your utilities, your insurance. You always have those costs. They're fixed costs. It doesn't matter how much of a product you sell or how much of a service you provide. Your variable costs, on the other hand, depend directly on the level of production. So let's say that you own a business where you change oil in cars. Your fixed costs will be things like your building and your utilities and your insurance. Your variable costs would be things like the oil and the oil filters, because you're only going to use as much oil and as many oil filters um, as you're going to need for the oil changes that you perform. We also have to know how to assign our costs. So we have direct costs, or sometimes referred to as cost of goods sold or COGS. And these are items or costs that are directly incurred due to something we produce. So let's say that you own a restaurant and the food that you buy is a direct cost of goods. So let's say that you have hamburgers and salads. The lettuce and the burger and the hamburger buns are all part of your cost of goods sold. There, you buy them and they go directly into what you're making. Indirect costs would be things like paper towels. You can't say how many paper towels go into each meal, but you know you need paper towels to run your business. And so that's an indirect cost because we can't say this roll of paper towels was used in providing this meal. And so that's kind of how indirect and direct costs work. Now we're going to move on to budgeting. Budgeting is really important because it shows a firm how it will acquire and allocate resources needed to achieve its goals. So some of the, and we see budgeting in our everyday lives. We have so much money and we have certain things we need to do and buy, and so we have to budget accordingly. And this is the same for businesses, nonprofits, and other, even government entities. So here's the benefits of budgeting. It helps managers identify how they plan to achieve their goals during the planning process and how they're going to use their resources, primarily in this case, money. It encourages communication and coordination. It can be motivational for some people, and it can help assisting in evaluating whether we met our budget or didn't, whether we spent what we said we were going to spend on the specific items or we didn't. So there's two ways to form a budget. One is called a top-down budget, and this is where top management basically prepares the budget, and there isn't a ton of insight from middle management and supervisory management. There can be some, and this depends on the organization and the culture of the organization. Bottom-up budgeting is where middle and supervisory managers help to create the budget.